Welcome everybody to tonight's JUMPinar. Just give us a few minutes here and we'll get started in a bit. Welcome everybody to tonight's Jumpstart Germantown JUMPinar. Just give us a few more minutes and we'll get started. Just give us another minute here and then we'll get started with our JUMPinar tonight. Oops. All right, well, it looks like our attendees level has flattened out, so we'll go ahead and get started tonight. Welcome to Jumpstart Germantown's JUMPinar, which takes place every Monday night from 7 p.m. to usually around 8:30. Tonight we have an exciting topic for Jumpstarters on refinancing and commercial credit. We're joined by Alex Richardson, who I'll introduce in a minute here. But before we jump into it, Angie, can you want to give any updates on Jumpstart Germantown?
Thanks, Derek. Yeah, as I say every week, we are lending. So we have gotten a lot of applications. We are approving a lot of applications, and we've closed on a number of loans for folks that are looking to purchase and renovate properties in our Jumpstart areas. So if you found a property and you need financing, definitely check us out, jumpstartgermantown.com, jumpstartphilly.com. As always, we are short-term, 12-month. And so for those of you that are doing buy and holds, you'll need to refinance. And so tonight's topic is perfect for that. And I just wanted to start by thanking Alex for putting this on. It's really great timing. We've heard from a lot of folks who are, having trouble refinancing or think they might have trouble because of COVID. So we wanted to get someone in here, with that expertise on the banking side to let us know how things are looking. So we're really excited to have Alex here. Also, Alex and I found out through this that we're both from Southwest or have Southwestern Virginia roots. So, so it was fun to find a familiar face from down south. But yeah, we're glad you guys are joining us tonight, and I think it'll be really great information.
Great, thanks, Angie. So just some tips for navigating tonight's meeting. If you want to submit a question, you can use the Q&A function on Zoom. At the bottom toolbar on your Zoom screen there should be a Q&A bubble. You can click that and submit questions, and we'll either get to them when we have a short break, or we'll hold them for the end. But we usually get around to all of them, so don't hesitate to submit any questions you might have. The chat will be disabled for the duration of his presentation, but I'll bring it up at the end in case you want to network or share any resources. And yeah, and then the last thing is we're going to have some polls tonight from Alex to kind of survey the group. So you'll just see those pop up automatically on your screen, and you can just answer the question really quick. I think we're going to have 3 of them, so just look out and make sure you answer them quick so we can keep the presentation moving a little bit. So yeah, without further ado, I want to introduce our friend here, Alex Richardson from American Bank. He has an educational background in sports management at Virginia Tech and bank management at the Virginia Bankers Association. His professional background includes over 20 years of experience in various aspects of financial services. He's focused on client relationship management and client and employees' financial wellness, and has specialties in commercial real estate financing, commercial and industrial lending, closely held and family-owned businesses, and equipment financing. So I'm going to hand it over to Alex here for his presentation. And once again, thanks for joining us tonight.
Thank you, Derek. I appreciate it. Hello, everyone. Glad to be here. And thank you for Angie for inviting me. And yes, we are kindred spirits when it comes to Southwest Virginia. I'm originally from Baltimore, and most people can tell right away when I get to talking that that's not Baltimore, nor is it Philadelphia, that accent. So it's a mosh posh of all of those things, but spent the last 20 years in Southwest Virginia after going down to Virginia Tech and meeting my wife, and we stayed and raised our family, and wound up coming up to the Philadelphia area where my wife has a family for the last now 3 years. This is the start of year 3. So we're pretty excited. I guess we just finished year 3. This is the start of year 4. So we are really excited to be here, and I was really glad to connect with Angie and, of course, find out about our Southwest Virginia roots as far as the Radford and Montgomery County and Giles and all those really cool places that may sound funny to you right now, but trust me, they are really awesome places to go visit and take some time out and see. So I'm glad to be here and glad to talk to you about just real estate and commercial financing of real estate and other things as well. But really, it's hopefully it won't sound too rudimentary as far as some of the stuff we'll talk about, but I'll try to intertwine some things in each of these slides that will kind of hit on what's happening today in today's environment, because obviously this is a completely different world that we're in now compared to what we've been used to seeing for the longest of time. So I'm going to go ahead and share my screen. So please bear with me, and hopefully I don't make any mistakes when I do that. But I'm going to share my screen and we'll kind of get started. So again, what I'm going to talk about in doing this is just the simple 5 C's of commercial credit. If you've heard of them, great. If you haven't, don't worry. It's really not that difficult, but it's something that is, it really is important, because you've heard, if you've had dealings with different banks and different bankers, every bank has their own loan policy and all these different things that they look at when they are determining whether or not they can do a commercial refinance or purchase, cash out for folks. And they all really stem around the 5 C's of commercial credit. So this is where it really starts, and then it breaks off into banks doing their own thing when it comes to their own commercial credit policy. So the first thing, okay, well, what are the 5 C's of credit? And so regardless of what you're seeking funding regardless of where you're seeking funding, be it from a bank, be it from a development corporation like Jumpstart Germantown, be it from a friend, family member, relative of a relative, a prospective lender will always want to review your credit worthiness before they're going to give you money. They're going to want to be able to determine whether or not you'll be able to pay back that money. And so the 5 C's of credit come into play here. So the 5 C's, it's a complete and thorough documentation of a loan request is really important. Having a business plan will help the lenders out as well. Just the basic components of credit analysts, we just need to know who you are, what you're trying to accomplish, and what kind of plan do you have. It's the basic relationship building that you may have heard before, but it's really important for a bank because we need to know all those factors before we start making a decision. And then while there are 5 C's of credit, please don't be mistaken or wondering how they're evaluated, if there's a percentage. for each one of these 5Cs? Are they broken down 20% each? No, they won't. One alone won't prevent you, and one alone won't guarantee you financing. So there's no formula, but just understand that these 5Cs are important to banks, and these are the things that we use. And then there's some offsprings of those 5Cs that help you help us determine the risk that you may have, or we may have as a lender, and you as a borrower for us. So at the end of the day, we want to lend money, and most banks want to lend money, but we want to make sure that we'll get paid. That's probably most important. So so we'll go over. Here are the 5Cs, and Derek, get ready for first poll. But here are the 5Cs: character, capacity, collateral, capital, and condition. So just real quick, what of the 5Cs do you think is the most important that a bank looks at? Now, again, I just said that they're not weighted, but there are some that are more important than others. What do you think is the most important of the 5Cs to a bank?
Great. So the poll should be active for everybody now. If you don't see it, maybe move around the tabs on your screen. But you can just, with a couple clicks, answer that question, and in about 30 seconds, we'll go over the answers. All right. Well, we have over 2/3 of people have answered here, so I'll end it up. And now, Alex, you should see the results on your screen now.
Awesome. So again, the 5Cs are character, capacity, collateral, capital, and conditions. And the number one response was collateral. Not the right answer, but not a bad answer. And the reason is, and one of the things that at least we say at American Bank, and trust me, I'll tell you a little bit more about American Bank later on in the presentation, but one of the things that we say is that, we're not collateral lenders. So collateral is really, really important, but there's a couple things that are a little bit more important than just collateral. But right following collateral was capital, which again, having the money, that is also really important. And then a tie for the most part for third place in character and capacity. So drum roll, please. The most important, believe it or not, is character. And you might be thinking, what? How could character be the most important? Well, we're going to talk about why character is really important when it comes to the 5Cs of credit for banking. Again, this is not the American Bank way. I didn't say this earlier, but the 5Cs, again, they've been around for years. A lot of this information that I obtained on the 5Cs is from SCORE. So I'm sure you're all aware and familiar with SCORE. And so again, this is not just American Bank's policy. I'm speaking as a banker, but not of American Bank's policy. This is just overall. And so this is why character is such an important piece to most banks. And the first thing is that it's subjective, obviously, but it's a subjective evaluation of the business owner's personal history. The lender, being me, we must believe that a business owner is a reliable individual who can be depended on to repay the loan. Background characteristics such as personal credit history, education, work experience are all factors in the business credit analysis. So character is the single most important factor considered by a reputable bank. The reason that we say that character is the most important factor considered by a reputable bank, because banks want to do business with people who are honest, ethical, and fair. We know if we're dealing with someone who's honest, ethical, and fair, you may have the money, but if you're not honest, ethical, and fair, that doesn't guarantee that that even though you have the money, that you're going to do the honest, ethical, and fair thing and pay back what is owed to you. The difference between the ability to repay a loan and the willingness to repay a loan is an example of someone's character. The knowledge, skills, and abilities of the owner and management team are vital components of this credit factor. So again, just because you have the ability to pay the loan does not mean that and I say you, but a borrower has the willingness to repay that loan for whatever reason. Being in banking for as long as I've been in banking, things happen. You may have all the good intentions in the world, but things happen. I mean, obviously, we're living in a time right now where COVID happened. And when COVID happened, a lot of things went sideways. And so what happened to our all of the loans that we had on the books and a lot of other banks had on the books, where you had to have some real long, hard conversations with people about how they're doing right now, how this has affected them right now, and if there's an opportunity, will they still be able to pay? Do we need to do some loan deferrals? What's the next step in order to either help you through this crisis? But again, more importantly, what are you doing as a borrower to make sure that you're taking responsibility and having good, honest conversation with us when we are having that tough loan discussions? When everything is great, of course, everybody pays, everything is fantastic, everything is wonderful. But when something breaks, when that link, one of those links break, then what? And this is where we are in today's world, is that the link is broken. How are things getting done at this point? So character, believe it or not, is one of the number one factors that we look at when we are making a decision for using the 5 C's of credit. So the next one is capacity. Now, again, this isn't an order of, okay, character was number 1, capacity is number 2. It's not. I just wanted to show character first based off of the poll question. But so capacity is just the next one in line. It's not the second most important. The rest of them are random. But character, this is an evaluation of the company's ability to repay the loan. The bank needs to know how you will repay the loan, repay the funds before it will approve your loan. Capacity is evaluated by several components, including the following. The first thing is cash flow. So this refers to, and most of you know this, is the income that the business generates versus the expenses that are run through the business. So if you didn't have if the business is a startup, we might ask for, and other banks might ask for, a monthly cash flow statement for a year. We want to be able to see how the business is generating income, and then what are the expenses, and are any are the expenses higher than what you expected them to be? And when you're in the real estate world, you all know that you're fixing up a property and you've got it fixed up and it's looking good, but are the routine maintenance, is the scheduled maintenance in good shape? The things that you're expecting need to be fixed, will those last like you think, or is something going to break down? If it does, are your expenses a little higher than what you were hoping they would be? A lot of times some people take 5%, et cetera. Some take a whole lot more than that. We always, as you can imagine, as a bank, we're always going to err on the side of a caution, and we'll say more than less as far as your total expenses. But we would rather not guesstimate what your expenses are. We would much rather what your expenses are, because you've done your homework. And this is part of that earlier conversation around character and having a business plan and really understanding what you're trying to accomplish and what do you think. And I know sometimes it is just a think. It may not be exactly what you think it would be, but again, if you're showing good work and you're showing that you're thinking about all of these things as they come up, then it shows that you're at least one step ahead of a lot of folks when you're thinking ahead of those regular scheduled maintenance things. And of course, when something out of the blue happens and you're not expecting it, how you're going to make those payments, et cetera. So that's the first thing we look for. Can the property support the loan? Because while we're going to take collateral, and we'll talk about all of that stuff, we're not in the business to own property. We're not in the business to take it back and sell it. We'd much rather you pay it back and you keep it. And so we want to first make sure, can the company, or in this case, the property, cash flow and pay for whatever loan amount you're looking for all by itself before we start looking at guarantors, et cetera. Okay, so the next thing is payment history. This just refers to the kind of like a personal credit, but the timeliness of payments. There are some companies out there like Dun & Bradstreet that can do some sort of payment history, but obviously, as a guarantor, et cetera, if it's brand new, you're not going to have much payment history. But we look at that's why we require, as American Bank, we're always going to require a guarantor on our properties. And so then we're looking at your capacity. So what's going to happen if for some reason on the cash flow side that the cash flow starts to run really lean and you don't have enough money and a pandemic happens or, you name it, but whatever happens, when that happens, what are you going to do to make sure that the payments are continue to be made? And then a contingent source of repayment. That could be, again, you are the personal assets, your savings, checkings, other resources that might be used. It could be your spouse's permanent job. We really like to have borrowers that have, on guarantors, that may have a steady income somewhere else. Right, that would be really, really nice to be able to say that this is your only source of income. I know that a lot of you may be getting to the point you would like for that to not always be that way, that this could be your sole source of income, and that's fine if that's what it's going to be. But I do want to make sure that that it's really helpful when you have another steady source of income, because that shows just another contingent source of repayment when the need comes up. So as a bank, we like to see somewhere between 6 and 12 months of payments liquid. So if that's a savings account, however it is, but if it's liquid, that's what we like to see from a capacity standpoint. All right. So the next one is capital, and I'll have Derek get ready for the actually number 3. I think I skipped number 2 because I gave the answer. So number 3 is capital. And so Derek, if you want to get ready for that, a company owner must have his own funds invested in a company before a financial institution be willing to make the investment. So what percentage of funding or capital do you think a bank likes to see from the owner? Turn some lights on.
Great, thanks, Alex. Just like the last poll, should be popped up on your screen there, and you can just click a couple buttons and have it answered.
Forgot it's getting darker earlier. All right, so what percentage of funding or capital do you think banks want to see from their guarantors?
I'll give it another 10 seconds here. If you haven't voted, go ahead and do that. All right, and that's just about everyone. So I'm gonna share the results with you there, Alex.
Right. So number 1 by a landslide is 20%. And then right behind is 22%. Good answers. Absolutely 20%. What you'll see here in a second, just from score, that number is closer to 25. I would say now in today's world, you would definitely be pushing more of 25%, if not 30 in some cases. So capital is the owner's personal investment in his or her business, which would be lost if the business fails. We definitely don't want your business to fail, obviously. However, you have to have that proverbial skin in the game from a lending standpoint. We need to make sure that, again, going back to that character piece, right? If we are putting everything up front and you're not from a monetary standpoint, what happens if things fail? Is it easier to walk away when you haven't lost any money? Absolutely, it's easier to walk away. So the single most common reason that businesses fail is undercapitalization. They do not have enough cash, enough capital to make things work, because times will be lean in the very beginning. So while there is no fixed amount that you must be vested in your company, lenders usually like to see at 25% on the conservative side of a company's funding to come from the owner. So again, that 20% is a really good number. Right now, in today's society, today's world, especially when we look at cash out, right now, at least at American Bank, you're looking at about 30% is the max. We'll do 70% cash out on a deal right now versus normally when we were doing 75 to even sometimes 80% when times are really good. So that's one of those things that we're doing as a bank to try to, again, just make sure because of the condition of the economy right now of how much we're willing to lend out on a loan to value standpoint for any new loans going forward. So I think it's really important too, contrary to what's advertised in the media, and usually in the media, there's always something about 0% or 100% financing. And again, I wouldn't disparage any bank that would do this, but in most cases, a bank would not fund 100% of a business venture. I mean, we just won't do it. In almost every case, any principal that will own at least 10% of the company is required to sign a personal guarantee for the debt. We don't have that requirement. However, we do have a requirement of guarantors. So there are very, 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 very few times where we would ever do a commercial loan that did not have a guarantor. So, so from our perspective, we want to look first at the business. How well is the business doing? In this case, if it's a single purpose LLC for this property, how is it currently managed? What we're looking for as far as what we would need to see from you about that company, about the property, rent, and again, I'll get into. I don't want to jump too far ahead with some of this presentation, but what are the things that we're looking for? But one of the most important things are try to get an understanding of what did you put into the company from the very beginning. And I know, if you started with Jumpstart, I know they have requirements on same thing. Again, remember when we first started, we talked about, doesn't matter who was loaning you money, you were going to have, the expectation is that they're going to want to look at your credit worthiness. And part of that is, again, what skin in the game do you have when you're doing a loan? So, so we're going to look at all those things. And that's where it's really important to build that relationship with a banker and be ready to have those conversations. You don't need to, trust me, you can't trick us because, or think we're going to forget not to ask a question, because we have so many layers, from credit analysis teams, et cetera, that if I missed asking you a question and getting some information, I can 100% guarantee that our credit analysts would not miss that question. And so they would come back to me and ask, and I would be coming back to you to ask additional questions. So that's where it's just really good to be as upfront and get as much information as possible, including, again, especially from that income and capital standpoint, and understanding is this your only source of business? Do you have income coming in from anywhere else? When we ask you about how much you have in the bank, don't be afraid to tell us the full amount. Because just because you say you have $100,000 in the bank doesn't mean we're going to say, well, we need you to put that full $100,000 in before I lend you $100,000. It doesn't work like that. We want to be able to see that you have that money because, like I said a few minutes ago, we're looking for that 6 to 12 months of payments. So in case something were to go sideways, you're giving yourself that 6 months at least where you can make the payments and give yourself time to get that property re-rented and back on its feet. So the more information you can share with us, the better. All right, so the next one is the collateral piece. So commercial real estate, machinery, accounts receivable, inventory, other business assets, anything that can be sold if you if you did not repay the loan, is considered collateral. A lot of banks, and you probably are hearing this, especially in the world of COVID now, where a lot of banks are not open to do business right now. Even if you have the collateral, even if everything looks good, they're just so afraid of the uncertainty that they're not willing to do that. Well, fortunately, we're not in those shoes. Now, we do have some parameters that we put in place, but we also are commercial real estate lenders. We do a lot of C&I, and we want to continue to do C&I, which is commercial and industrial, but we are commercial real estate lenders. Our bank was founded in 1997 by Mark Jandal out of Allentown, and that's where we're headquartered. That's our main branch. That's who we are. But we also have a loan production office for our commercial team, or part of our commercial team, which includes me and my partner Lou Monaco, who actually is my boss. We have an office also in Bluebell, and so we do. We work all through Pennsylvania, but I tell you about Mark Jandal and the Jandal family. If you're familiar, and if you're not, you can definitely look them up, but they are real estate investors. That's what they do. That's what they've done for many, many years. And they've owned this bank now for many, many years. So where you'll see some banks that say you don't want to get too heavy, and you may have heard that before. Well, we're trying not to be too heavy in commercial real estate. We're trying to diversify. And yes, we're trying to do some of those things too, but being that we're owned by a real estate investor, he knows that that's a commodity that is not being remade. Commercial real estate is as secure as you can get. And so as a result, we're not afraid to lend commercial real estate wise. And so I think that's just important for you to know. And that's important to know for whatever bank you decide to work with, understanding what their appetite is for certain types of lending. And again, for us, we are a strong commercial real estate lending bank. Sometimes when you're dealing with small businesses, and you may not have, in our case, we're all dealing with commercial, so I won't spend a whole commercial real estate. We wouldn't do a lot of small items and computers and things like that. They just, number one, they depreciate too fast, and we just, big office equipment. Yes, we do machinery. I did a loan just a few weeks ago for a crane. And it was a really big crane for someone that does the landscaping, arborist, I'm sorry. So, we do definitely large machinery and automobiles, et cetera. But those small things, we don't do a whole lot with the small stuff, because again, they depreciate too fast. You would not have enough. You wouldn't have enough value to probably borrow too much money. So, and then sometimes again, if an owner or guarantor needs to use some of their personal assets, or maybe you own your home and you have some equity in the home. We've done that as well, especially for some startups or some folks that may not have a lot of cash and want to have some extra, and we need a little bit of extra collateral. We'll use personal residence as well as a secondary source of repayment. Again, we're not. This is just a way to guarantee our loan, not necessarily. We're not always looking to do that. Because again, we'd rather use the collateral that's being used for the commercial real estate that's being used for the loan as that primary source. This is a secondary source to make sure that if anything goes sideways, we have a backup. And then, financial institutions will generally advance up to 80% on accounts receivable, valid accounts receivable. Again, this isn't necessarily the audience for accounts receivable. That's more commercial and industrial, but accounts receivable is if again, you're selling a widget and you have a lot of sales and you have a lot of income coming in, and we know that's coming in because you have contracts, et cetera. We do a lot of that as well. so I won't spend too much time on that. The next one is conditions, and that's where really pertains to today. What is the overall condition? So this is an overall evaluation of the general economic climate and the purpose of the loan. The conditions vary by industry. It varies by the industry that you're in and what the loan is for. Is it land? Is it equipment? Then the overall state of the country's economy will factor heavily into the decision. And that's where we are today. Conditions, we're at a crossroads right now. It's really a catch-22 because currently right now rates are really low. When I say really low, for a commercial mortgage right now, of course, I don't quote any of these rates, but I mean, you're looking at the high 3s to low 4s on a commercial mortgage. Now, for us, a commercial mortgage is not a 30-year mortgage. You're looking at a 5-year fixed, 10-year term, and then usually it's a 25-year amortization. Sometimes we'll only do 20, and that's one of those things that we're doing now because of the conditions that we're by amortizing it out lower than going down to 20 years. That just means more of your money is going to principal. You're paying it off faster, which the faster you pay it off, obviously, the better that is for both parties. And we know that you're creating equity in the property itself. But, when conditions are great, everything is fantastic. So if a company is in a thriving industry doing, that's doing great economic growth and it's just everything is fantastic, then of course, it's going to be a lot easier to get a loan versus an industry that's declining, that's uncertain, that has some volatility in it. And right now, obviously, it seems like every industry right now has some volatility in it. And so I know that's one of the things that, probably had you on this call today is just like understanding, well, then what will happen. So the other thing that's really important, and I'll get into that in a second, but the other thing that's important with conditions are what are the purpose of the loan? Are you looking to get the loan out to invest the loan in acquiring new assets and expand your portfolio? If that's the case, then you have more of a chance to get a loan versus if you're using the money just to pay your daily expenses. If that's all it's for, and again, sometimes you need to do that. Obviously, in this business, we understand how it works, where you refinance, you cash out, your property value goes up. And again, in most cases, hopefully you're using that money to expand your portfolio. So when those things are happening and you're using it because you have another property in mind and you want to use this as as part of the down payment, again, we're also looking at that skin in the game piece. So we still haven't forgotten that. But, part of that skin in the game is you've done really well starting off with Jumpstart to find the property, get it, get a construction loan, have that year to get it built up and ready to go. And now it's worth twice as much as what you bought it for. Well, that's perfect. Or the money that you have into it. Oh, that's awesome. Well, that is part of your sweat equity. So again, we're willing to walk through that with you and understand that, that's part of that equity process. But again, what are you using the money for? Typical factors include in this evaluation, in this evaluation step includes strength and number of competitors, size and attractiveness of the market, dependence on change in the consumer taste and preferences, supplier, length of time in business, any relevant social, economic, political forces that can impact the business. Before we got going, Angie, Derek, and I were talking about obviously all the Temple and Derek at Drexel and what's happening with students being in person versus virtual learning. We have a lot of and continue to do a lot of business in the student housing market. Even during the pandemic, we're still doing business in the student housing market, but it's scary at this point. When we first started doing it, we felt like, okay, back in April, May, even June, we kind of felt like, well, by the time we get to August, we'll be good. Well, now we're here and we see what's happened in the news. And so this was probably the most secure of all secure real estate lending would be student housing in Philadelphia, because it's a great business to be in. But right now we just don't know. Again, knock on wood, things are going well so far still, even though some folks are still learning virtually, but a lot of kids are still in Philly, and or even if they're not, their parents are still paying their housing, believe it or not, if they're not on campus. And so, but we look at those things. And so one of those things that we currently are looking at is this conditions, with this conditions piece of what are you using the money for, and what are you looking to refinance for? Now, again, Angie said the way this is working is that you have a year. You have a year to get your house purchased, constructed, and then ready to go on the market. Some of you are renting through traditional market rate rent. Some of you are in the student housing business. Some of you are in the Section 8. It does not matter to us. What we like to see is there a lease in place? And that lease for 12 months or close to it, a year, a month by month isn't necessarily the best, because that can change pretty quickly. Obviously, the longer the lease, the more secure we're going to feel that you're going to have income coming in from that property. So if you're looking to refinance today, and you want to be able to obviously refinance out of your Jumpstart Germantown loan, you may want to get some cash out. And I understand why you would want to get cash out, especially after you've put some of your own money in and you want to be able to recoup some of that money. I'm just telling you right now, that may be harder today than what it was in January. And it's because of the conditions. So again, the strength of you as the guarantor, the strength of the property itself, the loan to value of the property, it may determine how much cash out we can get. I've already told you earlier, is from an American bank standpoint, not all banks, we put a maximum of 70% cash out on our end. So while we're at 70% cash out maximum, doesn't mean that we'll do 70% cash out on every single deal. Because again, if the debt to income is too high, the loan proceeds, which you're going to be using it for, we may have to cut that down, or we may just have to say the most we can do right now is refinance to get you out of your Jumpstart loan, which not get it out in a bad way, but that's how the program works. Get you financed with a bank, and there is no cash out at this point just because of the current economic conditions. However, with you having the place rented, ready to go, got a 12-month lease set, maybe we come back in 12 months once things have kind of settled back down and things are starting to look more like normal, that then we can come back and do a refinance with some cash out for you to maybe purchase that next property. So, I want to make sure you understand, at least from an American Bank standpoint, how we're looking at things. At American Bank, we're not we don't have the appetite for speculative lending at this point. So if you were to come and say, I want to cash out and I have another property in mind, I'm going to use this to purchase it and put X amount into fixing it up, but there's no revenue coming in from it because I got to fix it up first, obviously. We may not be as keen on that. Again, we're going to go back to looking at our 5 C's and look at, do you have the capacity to pay, even though the house is not generating income? So the property, the collateral is not generating any revenue right now. And if you do, then maybe we can still talk. But if you don't, if we can't see that on paper, then that's where we might say, right now, we just can't give you cash out to find the next deal. If we can, we will do it. If we can't, the good news from our standpoint is that we'll let you know that. I know some lenders right now aren't doing anything right now. and are being told that they're so afraid of real estate that they're doing nothing. Again, I don't begrudge them for that. That's just where each company is. As far as a smaller bank like ours, we are doing it. You just got to understand what the parameters are. So obviously restaurants and temporary agencies, et cetera, they have high rates of failure. But the greatest challenge to any business is to attract and retain reliable employees / contractors. And the reason I just put that in there is that with all of this, it's just so important, especially, and I'm sure Angie and her team and you've learned this a lot going through your Jumpstart program. It's just so important to connect with good contractors, people you can count on that can get the job done and on time as promised, because time is money in this business. And so when you can find and retain good employees, if you have employees, or contractors that you're working with as you're getting stuff done in the commercial real estate world, it makes a world of difference in your ability to be successful in this realm. For most people, what I try to tell folks is that I'm not here to tell you how you should do your business, how you should run it, things that you should do. I'm just here to let you know that from a bank standpoint, what are the things that you need to be able to show. It's really, really great being a small business owner, because you get all the benefits that are allowed to small business owners, because you're the backbone of our country, of our economy. And we want you to take advantage of all those tax breaks, et cetera. But understand, when you take advantage of all of those and you don't show income, then it becomes really hard to come to a bank for a traditional loan, because that's the first thing that we're looking for. And we saw a lot of that in this PPP world where, folks are struggling, but if you can never show income, and you can never show, but when you can't show enough, then you say, but this is how much really I'm getting, but I'm not showing it because of my taxes. Well, that's all we can look at is your taxes. So you got to be able to balance, how can I show enough and pay taxes on what I need to pay, but show enough income that when I do need the bank, they have enough what they need to be able to give me the loan that hopefully give me the loan that I've come to them to talk about. So, so the last thing I want to talk about, just from from an American bank standpoint, some of the things, and this is us. However, I've worked at BB&T, I've worked at Bank of America, I've worked at a bank called Atlantic Union Bank, which is out of Virginia. This is pretty much standard across the board. So while this is our information, most banks are looking for these things. So when someone's coming to us for commercial real estate and wanting to do a commercial real estate loan, here are some of the things that we're looking for. And I wanted to put this in here just so you can understand and kind of prepare yourself when you are ready to go to banks. That again, the more the merrier. The more information you can provide, the better. Because again, the more upfront you can be and the more open conversations that we can have, you'll learn, especially, this is just me talking, but I just like to get it all out there, because there's nothing to hide. It's really just making sure that you have a better understanding of what you need, so that you don't have to keep going back, and I don't have to keep coming back to you to ask for stuff. So some of the required forms is the signed business loan application. We need to know what kind of business this is. If it's a sole proprietor, we need to have the information showing it's a sole proprietor. We need your LLC articles of incorporation and your operating agreement if you're an LLC, which a lot of you do, LLCs and sometimes single purpose LLCs, which is, again, it's perfectly fine. If you are set up as a corporation, we are going to need your articles of incorporation, your bylaws, your resolutions. And then if it's a partnership, we're going to look for those partnership agreements. So as soon as those are going to be those things that most banks are going to go, I need to see your legal documents. That's what this is your legal documents. And then the financial information we're required, from us, it's going to be 3 years business tax returns. And again, if you're working with JUMPstart, you may be just getting in the game. If you're not, I mean, you may still have been in the game for a while. So if you have business tax returns, we're going to look for up to 3 years tax returns if you've had 3 years. If you've only been doing it for a year and have a year, that's fine. If you're running as an LLC and it's a single purpose LLC and it's just going to be in your normal 1040 personal tax returns, we're going to ask for 3 years personal tax returns as well. So even if you don't do business tax returns because you have a Schedule C or you have related entity K1s, we will ask for those along with your personal tax returns. So 3 years of business tax returns. The signed business financial statement, really it's the PFS, which is on the next one. But the business debt schedule is important. So in this case, we're looking at and I think it's over here on the other side too, but rent rolls, your debt schedule, if you have a number of properties, understanding where they are, if there's a mortgage on them, for how much, the rate that you're getting, when does it mature, et cetera. Those things are really, really important. And it shows that you're really an understanding of this is a business for me, and I'm taking all the right precautions to make sure that I have all the detailed information, that I'm showing that I'm on top of it, which then helps the bank understand it better as well. Then on the personal side and for the guarantors, like I said, we'll need that PFS, that personal financial statement. Again, we have our own. There's some out there on the web, but it's always good to always have a personal financial statement, always keeping it updated. Schedule of your real estate owned, your global cash flow is really important if you have that. Again, your 3 years personal tax returns, your any tax returns that you're guaranteeing. So if you have other entities that you're guarantor on, so those single purpose LLCs, we will look for those. And then any related entity K1s if you have those as well. If it's a purchase or investment of real estate, if it's a sale, we will need to see that agreement of sale or letter of intent. Again, we want to see the current rent roll on the property that you're getting. Is it currently rented? Do you have to fix it up? And so that way it's not currently rented. So is it generating income right away? We're going to need those copies of leases. Again, the leases don't have to be 12 months. However, the longer the lease is in play, the better. If it's a month to month, again, that has some effect on the loan process because that could change month to month. So, and then any historical property expenses. A lot of times, again, when you're in this business, sometimes you think everything looks good until that AC breaks or the boiler breaks or hot water heater breaks, and you may have some one-off. So just keep track of your expenses. And when those expenses look out of whack one year, just keep track of that, because those are one of the things that we're going to ask you, because we really want to help you get the loan. So you may have a couple years of rent, of property expenses, and 1 year the expenses were really high and the next year they weren't. So I'm just going to ask, well, what was that? What happened? Was there a one-time expense in here? Give it to me in writing so that then I can go back to our underwriters and say, this is what it was. This is why it was where it was this year, but this was the reason. And that shouldn't happen again because that was a one-time large expense. And then some of the optional equipment, optional information that we ask for as well is your website and company information. If you have some, if you don't have a website, don't see this and go, oh gosh, I should have a website. No. But again, going back to the character component, tell me about your company. How long have you been doing this? Is this your first? Is this your second? What's your plan? What are you trying to accomplish? Even if you're not there yet, by having that information, it helps us understand your mindset, because I can't read your mind. And then tell me about you. If you have another job, what is that job? How long you've been doing that job? This is a second job, quote unquote, to your regular W-2 paying job. Tell me about that. Are there plans for you not to be in that job anytime soon? Just getting an understanding of what what do you see your future looking like over the next couple of years? So just understanding who you are. Maybe you are getting into this and everything is brand new to you right now. However, your mom or dad were a contractor, and it was in your blood, so to speak. And so you may have some other pieces that would be good for us to know. So again, the more information, the better. Any projections? Obviously, again, if you're buying something for the first time, or you just rented it after you just finished your Jumpstart, and you want to, it's now rented and it's ready to go, and you need to get this thing refinanced. Give us any projections if you say you don't have the rent yet, or if you just got it. Anything else, or any plans for the future? And then again, that business plan. Including, we say resumes, but really we just want to know a snapshot of who you are, who's in front of us, and who's in front of us trying to get this loan. And it's that personal touch, it's the relationship piece that's, again, really, really important to banks. So that was a lot, but that's where I'm stopping. But I want to open it up for questions or comments or anything that you may have. I'm an open book. If I don't know the answer, I promise you I'll get it for you.
Great. Well, thank you very, very much, Alex. That was a lot of information. You're right. But I think it was broken down into sections that made sense. So thank you very much for that. And I'm sure we'll get a lot more information from you out of the Q&A, I'm sure.
Absolutely.
I just want to remind, I think Angie has something to say, but before I get to that, make sure to submit your questions using the Q&A tab. We'll probably be able to get to all of them, and don't hesitate.
Yeah, I just wanted to, while I see that we do have some questions, but while some more are coming in, just let folks know that, even though Jumpstart isn't technically a bank, all the stuff that Alex said, definitely when you're applying to a Jumpstart loan, think of us as a bank. We can be like a practice bank, even if we're your very first loan. Like, we want to mimic that bank experience. We might be a little more forgiving and hand-holding, but be as professional with us and our application, as Alex is talking about with bank applications. How you present yourself, very important. That character piece, like you said in the beginning, definitely an important thing. We, kind of what Jumpstart is all about is character and doing good by doing well. So that's definitely in our blood, but just, making sure that shines through in the application as well. So yeah, I took lots of notes. This was excellent. I'm really excited. I think even the folks that didn't get to sign on tonight, we'll have this up on video, and I'll definitely be putting a link to this anytime I'm sending out email to borrowers to say, hey, when you're ready to refi, make sure you check this out, because a lot of great info. All right, I'm gonna let Derek go through some questions now.
Awesome.
Sure. So just since we were talking about character there, I jotted down a question, and that's my only one. I'll let the rest of the attendees get to it. But I wanted to ask, what are some simple, easy to forget things that you can do to prove character to a bank? Like, what are some things that people just look over and don't realize that if they did this simple little thing that would show their borrower that they're a trustworthy person?
Yeah, great question, Derek. I mean, the first thing is, how do you handle your own personal credit, right? Understanding that your credit score is a snapshot, like it or not, of who you are. Right. And so just because you may have had some history, had some issues in the past, and maybe you were late on payments or whatever have you, that doesn't end everything for you. What we look at and what banks look at as a whole is, how did you overcome that? So looking at your own personal credit score is like the first thing. And being upfront, the more information you can tell the bank, the better. And even if it's bad information. And so that's the number one character piece, is that, if your credit score doesn't look like you want it to, but you call and we have our first conversation, tell me that. Don't tell me your credit score is a 720. And then when we finally get to the point where we're pulling it, it's a 680. That's still a big difference. That may not seem like much, but that's a big difference in the banking world, because for banks, they like 700 or higher. And so if it's something that looks funny, just tell me up front. Don't let me find out. But that's a simple thing of just giving that information that you might not even think, because you may be embarrassed or you don't want to really talk about that. Just tell it. Just be upfront and tell it, and you'll be surprised. Because then, as I'm getting to know you, I can say the score is here, but if you look at their credit, you can see where the issues were 3 years ago, but look at the last 3 years and look how they've paid. So things like that can easily be worked around. It's not, again, the number isn't the be all end all, but because you came to me first and you didn't try to say it was something that it wasn't, you presented the problem first without me having to discover it. That gives me the feel like, okay, you're really trying to work, and you have good character because you're not trying to hide from it, facing it head on.
Yeah, no, that's something I think we've heard at least half of the JUMPinars that we've done is just like the more information out there, the better. And yeah, I think you're totally right with that. It's like, I think it also saves time on both your work ends. Like,
Absolutely.
The quicker you bring something up, the less there is to be surprises down the road. So I hear that.
Absolutely. And even if it's a biggie and you can't get around it, at least we can address it. To your point, Derek, you say that, Tom, in the front end, and then I can tell you what you may need to do, that maybe we can have this conversation again in 6, 9, 12 months.
Right. Great. All right, so we're going to move on to some of the submitted questions here.
Okay.
Hernan Joaquim is asking, on new construction loans, what rates are you seeing from banks during COVID?
Again, construction is one of those things that is that's difficult for us personally, because we consider it speculative, because you don't have a lease in place. You're building it, you feel good that it's going to work, but if you don't have a lease in place, there's that speculation. And so you're going to have to be really strong as a borrower and a guarantor. But rates right now, you're looking in the high 3s to mid 4s, and refinance and construction loan rates right now.
Great.
And we do, like, personally, we do a construction to perm, so it's one loan, and you just do it. Do the construction draws with, depending on the size, you can get 6 to 12 months of interest only, et cetera. So we're doing all those things. But I will, again, just being completely upfront, they're harder to get right now because of the speculative nature of them.
Sure. Another related question, someone's asking about, or Michael Gordon's asking about commercial loan interest rates. Is it similar?
Similar. Obviously, the commercial real estate loan interest rates, you're looking at the lowest, which are in those 3s to 4s. Once you do a commercial loan, which then is secured by, say it's equipment or something other than commercial real estate, yeah, you're still in the 4s though. So again, I mentioned earlier on, I did a crane loan. That crane loan was, it was, I think, somewhere around 4.5%, but it would have been for something like that. That's a fixed term for maybe 5 at the lowest, I guess, depending on the size, up to 7 at the max, but most of them are between 5 years. And it's not a long-term amortization like a commercial real estate loan would be.
Sure. And that's a perfect segue into I promised our last question about rates here from Antonio. Asking, what are the interest rates we are seeing now for a residential commercial loan for 25, 30-year amortization?
For again, going back to the commercial, 25 is, at least at a bank like American Bank, 25 is the most that you're going to get on an amortization. We won't go 30. We'll either go 20 to 25. But yet again, depending on the collateral, meaning the property itself, the loan to value of that property, as well as, the location, is it rented, et cetera. Again, you're looking at most of the loans that I've done, even through COVID in the last 6 months, have not been over 4%, have been between 3.75 to 3.95. Actually, I did a couple that were around 4.25. So still really good rates. 5-year fixed, 10-year term with either 20 or 25-year amortization. And so unlike that residential mortgage that you would get for your own personal home. We don't do and just to give you an example where say I did a 5-year fixed. So what happens after 5 years, you still have another 5 years to pay it, but now the floor is where that rate was. So say it was at that, it could still stay at 4, won't go less than 4, but it could go up if the prime rate went up. But for that 5 years, it could fluctuate a little bit. But then after you get to 10 years, you either have to pay it off or refinance it. The amortization just determines how much your payments will be. If it's amortized over 25 years, your payment will be lower than if it was amortized over 20 years. So, but that might be 4% for a commercial loan like that, where if you were to buy a second home or investment property on the secondary market, like a traditional 30-year amortization mortgage, that mortgage might be, almost 5% for an investment property, but you're getting a 30-year amortization and you leave it alone, but you may pay quarter, half, almost a full percent more to do it that way versus the commercial loan way.
Okay, great. Now we have a couple questions here about American Bank specifically.
Sure.
Bridget is asking, does American Bank refinance for both commercial and residential properties? And I think I know the answer, but maybe
yes, we do. We do both commercial and residential. But with us being a small bank, we will only do residential in Pennsylvania and New Jersey. On the commercial side, we will do everything in Pennsylvania as well. New Jersey, we don't go and solicit business in New Jersey, but if someone has property in New Jersey and they come to us, we will do property in New Jersey as well. And
great.
We do refinance and purchase.
Cool. And last question here, just kidding, another one was another 2.
That's fine.
That's what I like to see.
Yes.
So Joyce Johnson is asking, do you handle nonprofit lending? They're a senior pastor and looking to purchase housing to lease to own for members.
Absolutely. Absolutely. We've worked with a couple of different nonprofits in the Allentown market where our bank is headquartered. So yes, we do. Short answer is we absolutely do nonprofit lending as well.
Great. All right. So now looks like we have a little situation here. I was in a situation where I was trying to purchase a mixed-use property that is current running laundromat. As a new business, I was looking for financing for the business and property. My question is, could I get financing if the seller of the commercial property doesn't have previous tax records or a lease in place? Do you need an equipment loan on washers and dryers? How would I be able to finance a deal?
Yeah. Obviously the first thing we would look at is the real estate, and does the real estate, whatever they would be paying you in leases for that mixed use, is all that revenue coming in from the laundromat? And I'm assuming however it's set up, if it's residential coming in, does that support the loan? You are going to need some sort of, personally, I wouldn't purchase anything without some sort of numbers from the seller showing the type of revenue that they're producing. How do you know that it's that the revenue that they are claiming that they're getting from the laundromat is actually what they are getting? So I would definitely want to see something like that. If most likely if you're purchasing the real estate and you're purchasing the business itself, you should have an amortization schedule on the value of those washing machines. Again, it might be one of those things that we may or may not do. We just have to take a look at it. But if the real estate could cover it all, then you're fine. You wouldn't necessarily need to get into financing or getting some sort of UCC on the washers and the other equipment. But I'm assuming all that's going to be included in the price of the of the purchase. So, but most important, you got to get information from that seller, because that's your due diligence, that that it is cash flowing like you hope it would.
Mm-hmm. Yeah, Ronald added that he physically empties out each machine every week, so he sees the income. Yeah, on the washers.
Yeah. Well, I mean, he's got, as long if he's seeing it and then he's putting it in some sort of Excel sheet, and that's kind of, and I'm glad this question came up, because that's what I mean about small businesses and your ability to, how do you toe that line between what's claimed and what's not claimed? And when you're in a cash service business like a laundromat, like beauty salons, barbershops, et cetera, and you're dealing with cash, it's really easy to not show all the cash that you're getting. The problem is when it comes time to do your taxes and you say that I don't make any money because my cash money is very small, and then my expenses eat it up, and maybe I'm showing a negative profit, but you're surviving. So we know that you're making more than that. And if you're not claiming that cash and then paying taxes on it, you're going to have a really hard time going to the bank to get money from a bank, because the first thing we're looking for is tax returns and showing the income that was coming in. So seeing it is one thing, showing it is a completely different thing. And you got to be able to show enough that you know that it's going to meet a bank's need from when it comes to needing money from a bank.
Great. Anthony Robinson is asking, for a developer's first rehab, would you consider refinancing a property if the developer has a Section 8 signed lease?
Absolutely. Absolutely. I just finished one. The Section 8 signed lease was for 2 years, which is even better than a 1-year lease. So if the Section 8 signed lease is in place, absolutely we would. We're not collateral lenders. We're looking at, I mean, we're more collateral lenders than just cash flow. But if the collateral is good, the cash flow, the rent that are coming in is paying for the property. We don't care if it's Section 8 rent, student rent, or just commercial real estate for business rent.
Cool. Money's money, right?
That's right. As long as it's coming in.
All right. Another question here from Keith asking, how much, if at all, this is a really good question actually, how much, if at all, does positive community impact factor into securing a commercial loan? Your numbers aren't the strongest, but the commercial tenant of a mixed-use property provides a much-needed service to the community. Does that hold a stronger weight?
It can, yes. Yeah, the short answer is it can. Again, it's one of those case-by-case basis situations. When you're looking at a loan, you're looking at cash flow. We kind of like to stay in that 1.2% cash flow, meaning, if it was bringing in, $120 and it's costing you $100, that's 1.2. Sometimes we may go less than that 1.2. We might go down and squeeze it a little bit based off of a situation that was just asked, Derek. So it really just depends. Now, if it's not showing, if you think cash flow 1-to-1 means for every dollar you spend, you're making $1. Anything that's not making you money is going to be hard for a bank to do a loan on. So we definitely aren't going to do negative. But if it's less than $1, then you're telling us you're losing money. So it's got to show that it's making money, or it's going to be hard to get the deal done. However, so community impact does have some play in it. Again, how much is just going to depend on where the numbers play out.
Great. All right, and our last question, it looks like here is from Stefan Williams asking, what percentage of the loan should be supported by the real estate income to look favorable to banks? Is there a certain DSCR that banks want to see? That's
that 1.2. Yep. So we're looking at a DSCR. For those that don't know, that debt service coverage ratio of 1.2 is usually at a minimum for us. We like to see it we like to see it more like 1.25. But 1.2 is right now from our bank standpoint is our baseline. So that's what you're looking at from a DSCR on anything. Anything higher than that is really good. Anything lower than that, that's when it becomes a little tricky.
Great. Yeah, at Jumpstart, we look at 1.25. Same. People are probably familiar with that number when they're filling out a pro forma. That's under our cash flow.
Yep, same here. So we're a little bit lower, and again, I think it's part of that is because of you know, a lot of those other factors that we take into consideration, and
Right.
so we're able to lower our DSCR just a tad to compensate.
Gotcha. All right. Well, thank you again very, very much, Alex, for that great presentation. And like Angie said, I'm sure this is going to be circled around a lot through the Jumpstart community. Just to give people an indication of what's happening in the future, we have Steve Masters next week on September 21st, speaking about L&I and obtaining permits, and you know, what departments to go to for certain things, and just how to, you know, we had a few presentations a few months ago about L&I, but this is from yet another perspective, which is always beneficial. And then I think we're still working on the 28th, but we will announce that when we find out. You can go to jumpstartgermantown.com and go to the events page to see what we have scheduled, and also to find the links for the registration pages. And you know, those are also the links for both our loan programs that Angie referenced in the beginning.
And I just wanted to put the word out there. I know Derek put it out on Facebook, but you guys who are attending are certainly experts in something. And if you would like to be a JUMPinar speaker, like Alex did tonight, please let us know, because you know, we know that there's a lot of talent in the Jumpstart community. And so please, you know, send us an email, let us know. We'd love to you know, share your expertise with the rest of our Jumpstart community.
Great. Thanks, Angie. And as always, you can view the recordings at jumpstartgermantown.com/jumpinars. We have everyone since we started doing them back in, must have been, what, April, right, Angie? Or
maybe May, 1st of May, I think. Yeah.
Time's flying, but we've been gathering quite a bit of recordings, which is great. So you can view those there, and they're just the same thing as this, except without the Q&A function. But yeah, I think that wraps everything up. So again, Alex, thank you so much for joining us tonight.
Thank you. Glad to be here.
Great. All right. And I think there was one question about whether we'd be able to get your slides to send out afterwards.
I'll send them to you. Absolutely.
Great. I'll send a follow-up email to all the registrants in the morning with all that information, as well as the link to the recordings.
Awesome.
All right. Well, have a good night, everybody. And we'll see you next week on the 21st.
Thank you all.
All right. See you later. Thanks again, Alex.